Ladies and gentlemen, a domino may have just fallen this last week with the collapse of Silicon Valley Bank and Signature Bank. It also could just be a blip on the radar. In the next 3 weeks, we're going to be talking about something completely different. That's how quickly this economy has been changing. About every 3 weeks, the narrative completely changes. And that's why we do the Great Report every single week. So if you're any type of multifamily investor, active, passive, or if you're someone that's in the industry, again, that's why we do what we do every single week on the Great Report, covering the multifamily industry, housing, commercial real estate, and the economy. So you can make the best and most well-informed decisions. Again, whether if you're an investor, you're an operator, or if you're someone that's working in the multifamily industry itself. Things are moving so quick and we have to stay on top of it. By the time some folks in the industry learn about what's going on in the market, there's a completely new story and set of data that's moving the other direction. And it's important to have some context, aggregate it all, and try to analyze exactly where we are, where we've been, and what the future might hold. So again, exciting episode of the Great Report. We're covering not only how the collapse of some of these banks may be affecting the financial system, specifically the multifamily industry. We're also talking about inflation with the CPI report that just came out. We also have the producer price index that was just released yesterday. We have a piece from RealPage looking at the spread between Class A and B apartments, then several articles on rent growth and other apartment KPIs. The Midwest has been crushing other regions with several Midwest metros, Indianapolis, Cincinnati, Columbus, Kansas City, just to name a few, keep coming out on top. And then finally, we have a piece from Apartment List looking at supply between the multifamily market as well as the single family market. Make sure you watch this whole episode to get all the pieces of information that you're going to need to make some really smart decisions. Make sure you're subscribed to the Great Capital YouTube channel. Leave a comment. If you have any questions, call us out for being wrong or right. And all right, let's get into it. All right, everybody, welcome back to the Great Report. I'm joined again by Director of Communications and Marketing here at Great Capital, Dr. Matt Bosnagel. Matt, how you doing this week?
I'm doing pretty well. I've been scrambling and then just hungry for news. It has been an exciting week for sure.
It's been incredible. So last Thursday, Matt, we were taping the last episode of the Great Report, just as all of this news about Silicon Valley Bank, Signature Bank, and a threat to the entire financial and banking system was starting to unfold. And I'm almost glad that we didn't start reporting on it then, because there's so much that's happened and changed, and things are still happening. We don't know the full effect.
Yeah.
But and I'm not a banking expert, and so a lot of this is just not necessarily new to me, but I have maybe a surface level understanding of all the inner workings of the banking system and, all the mechanics that make, the economy run.
Because all the stuff that they were talking about, everyone, I think, that's been listening to the Great Report, it's the same vocabulary when it comes to interest rates and expectations and all the trends that we were so closely watching. Finally, they're coming into play, just not in the multifamily market.
Yes. Yeah, not in multifamily. Exactly.
But dramatically so.
Yeah. All I know, Matt, is when I see the President of the United States come out on Monday, and just before markets open, having to reassure the entire country that the banking sector is sound and, the financial systems of the United States are going to work. And he has to repeat it 3 times. And then you have messages from banks, calls from bankers going out and saying that, the bank's not going to fail. That doesn't exactly instill confidence, and lack of confidence and sentiment and fear and panic is exactly what really caused this. And we can talk about, and I think we should, some of the underlying technical reasons why Silicon Valley, SVB, and Signature Bank, and most likely other banks and other
Hmm.
financial
Yep.
institutions are in a tough spot relative to purchasing seemingly low risk bonds and mortgage-backed securities. Um, but what the effect is of rates moving so quickly, so
That's
high that no one was really expecting. But so we can talk about those underlying reasons, but it's the psychology that's driving this run of pulling
mhm.
money out that's much more powerful than the
Yeah.
underlying actual financial conditions.
But I do that was something that the psychology adds is great drama, especially when it comes to the recent uh bank failures. But the whole atmosphere of higher interest rates is creating this vulnerability. And it was almost like there was a vague expectation. We didn't know what specific sector where it would hit.
Yeah.
But as long as it kept going higher and higher, there was a chance somewhere in the economy someone would have made a wrong bet. And this is an example of something that could be, it may not be the specific types of what was a 10-year back mortgage or 10-year mortgage back securities that was involved in the Silicon Valley Bank, but there's other things that are linked to interest rates, and it could be much more widespread, at least when we're talking about risk and vulnerability as interest rates go higher.
Yeah, there's a lot of financial institutions and product that, were not anticipating the type of volatility that we've seen. And Matt, to your point, we've been talking about something breaking. We knew that
Hmm.
these rising rates were going to put strain on the economy. That was the whole point. Um,
Yeah.
and the idea was to kind of break the economy. Really, I mean, the true goal was to bring the unemployment rate up. I mean, that's been the challenge for inflation. But the Federal Reserve has certainly broken something here. Not that Silicon Valley Bank and others didn't maybe make some wise investments and did diversify, which I don't think is. I think that is maybe not. I think
Yeah.
that's part of the story, but I think it's what banks do with their deposits
Hmm.
and is more of the story. And if you were buying 10-year treasuries a year ago, you were paying, your rate was 1%, or
Hmm.
less. It was a fraction of what it is today, and
Yeah.
the price of those bonds are inversely related to yield and interest rates. So all of a sudden, the 10 years it was at almost at 4% a week ago. Now it's at 3.5, and that's a whole other
Hmm.
story in itself. But regardless, that it's significant devaluation of that investment, and so
Yeah.
now they're still liquid, and it won't be necessarily a loss if they hold on to it for 10 years if it was a 10-year bond, 10-year note. But I mean, they've got a 10-year investment that's yielding 1% when right now they could go out in the market and get 3.5. And there's
Yeah.
a ton of institutions that have a ton of these no low risk investments on their books.
That's why and some people were like, well, they shouldn't have done that. It's like, but like when they were buying all of these 10-year bonds that would have later become hard to sell because they don't come less valuable unless you're intending to sell them and you need to sell them. But I mean, I guess they should have thought about a bank run scenario where they needed more liquidity. That's like the bad bet that they made. But it also, and how I would characterize this, and I kind of link it to this search for distress in the multifamily market that hasn't really been as dramatic as we've seen in Silicon Valley Bank. But what they made a bet was that rates would be lower for longer, at least if they wanted to sell. Their safest stress test, I guess, would be that would would be that rates were longer, and then these 10-year back more or 10-year MBSs would be easier to buy and sell in case of like a liquidity crunch. But what happened instead was maybe the worst case scenario.
Well, no one thought that rates would have risen as high as they have. I mean, if there certainly was a margin of error, but we've just kind of blown past their normal models. So this all brings up the question, Matt, of is
Hmm.
this, we're just getting into a year of since these interest rates have been started to rise at the Fed funds rate and um, all other types of interest rates. What is the next several things that we're going to see? And there's a sense that we're seeing all kind of things starting to bubble up. Um,
Hmm.
just inside, the multifamily industry, we're hearing more and more stories of borrowers with their back more or less against the wall, or at least a sense that their back is kind of starting to go into the wall.
Mhm.
In several of the reports that we have today, I know in the Yardi Matrix report, they mentioned that there are already properties being handed, the keys are being handed back to lenders.
Yeah.
That there are folks that are having to negotiate with their lenders right now. People that are just burning through cash.
I mean,
And
and that's the thing that boggles my mind is we've been talking about this like week after week, this very situation, and to see it happen in another whole area of the economy was really surprising to me, actually, because I was expecting it so much in this multifamily, and I didn't really
well,
realize
yeah, I think
how widespread
that's
the
what we're
vulnerability.
focusing. Yeah, well, I think that's what we're focusing on. But
Yeah.
no, I think it's a good point. And where else in the economy? And it's these black swans out there
Hmm.
that we're not really thinking of, because we may not be aware of them. There are all of these large dark pools of money floating out there in these somewhat opaque financial products, and very few people know how they work or that they even exist.
Hmm.
And also, there's a ton of lending that has moved away from the banks. So there's a
Hmm.
lot of exposure outside of the banking industry to a lot of private lenders, and what type of problems could arise, and what type of risks could be present, because they don't necessarily have the same risk profile, and
Yeah.
they have a typically more aggressive tolerance for risk than a bank may have, or a bank could even have if they wanted to. Um, so I think we're in for an interesting period here. And the big macro question related to all of this is, what's the immediate effect and what are the long term effects?
Yep.
Immediate effect is interest rates are down, crypto is up, people are getting out of the financial system in general. Whereas a week ago, all of a sudden, CPI was just a little bit still hot, a little, and people were saying, maybe we're going to have another 50 basis point rate increase.
Hmm.
Now, I mean, this essentially will have the effect of tightening in the markets, because there's liquidity that's going to be pulled back. Banks are not necessarily just going to be lending more because of all of this. The values of a lot of these banks have dropped. Their stock prices have,
Hmm.
fallen in most, not all cases. This makes me know their prices have actually increased. But there's less money in the system, and spreads have blown out. And we've seen now that they're one of the first times there's an inverse relationship between the 10-year treasury and the 30-year mortgage. The 30-year mortgage has increased last week, while the 10-year treasury has gone down 50 basis points. That means the spreads are widening and blowing out. It's because the banks are pricing in more risk to the system. And now the forward curve on Fed funds rates and interest rates has come down, potentially seeing rates drop near the end of this year again. Last week on the Gray Report, Matt, we were talking about there's no
Yep.
way that could ever happen.
Yeah.
And I still think probably not, but who knows? It's literally,
Well,
yeah, sorry, go ahead.
and no, you are totally right. Who knows? I have listened
I was
and
hoping
read
you're like, no,
all these takes, and everyone is predicting a different, or is suggesting that the Fed takes a different direction. Some people say it's great they bailed everyone out, but keep the interest rates high. Some people say let's bring the interest rates low, but we should regulate. We should regulate more. There is so many different solutions. I put that in very big scare quotes, and it's going to be really interesting because I think there is a little bit of a point to another a real bold move would be another 0.5% basis point increase, to really, because the same emotions that are covering a bank run is kind of the same emotions that keep people spending more and more when it comes to inflation. So if we can keep those emotions in check with a 0.5, like I'm still committed, then that might make things really interesting. But the other thing is, and like I'm all for a little bit lower rates, because I think that all the interest rate, all the inflation that we've been seeing, I don't trust someone that says let's raise rates unless they are taking shelter out of their CPI inflation calculations. Because that really drove everything, and we'll
Yeah.
kind of get to that. But, yeah.
If I think I'd agree with you if their basis is if they're saying we need to increase rates because of CPI alone.
Mhm. Yeah.
I'll give you maybe a devil's advocate to that in an argument why they raise rates 50 basis points, and then a completely unfounded conspiracy theory has no basis or evidence behind it. Okay, so case for 50 basis points. Time to just like take this the economy, take inflation behind the shed, put a bullet in it.
Yeah.
It's on its knees. Got to do a finishing move. Just get it over with. Let's get this pain over. 50 basis points. It's going to make the dollar very strong. It's going to cause shock waves. There's going to be pain. It could send us into recession. That could be horrible. That could be exactly what the economy needs. I don't know. I'm just that it's a possibility. Conspiracy theory. That's everything you said, Matt.
Yeah.
The investor class, whatever you want to call it, everyone that's paying attention to interest rates because they've been addicted and their business models are completely based upon free money, low interest rates, and may have millions, billions of dollars on the line that if rates aren't lower by the end of this year, they're going to lose. Again, millions, billions, I don't know, trillions across the economy. Feeling the pain, making it nervous. To what lengths would one go to cause, create the psychology and the panic to then create the will for the Federal Reserve and the central banks around the world to lower rates and bring back easy money? Now, one could say you need a recession to really bring rates lower, but if you just want to, ease the pausing and have plateau and just stop the rate hikes, you need some kind of crisis and panic. The central banks, the federal government, they act in a crisis and they overreact in a crisis. And often the case when they overreact, the economy can start to recover, or at least the stock market, maybe not the economy, but the stock market starts to come back because, once the Federal Reserve starts pushing on the gas, that just adds so much fuel to the fire. So I don't, so between these banks and then it's really the Credit Suisse piece as well, the Swiss bank that essentially is being bailed out with, I think, $54 billion from the Swiss central bank or Swiss government, essentially. That's causing the European Central Bank to only raise their interest rate by 25 basis points. Again, not found in anything, but certainly there's motive. But
whose pain is it? And are the people who are feeling the most pain likely to take a Federal Reserve official out to dinner?
Yeah, well, I'm just saying there's a lot of people out there that would really like to have interest rates be lower. And how do we create at least the perception, if not an actual crisis, but at least the perception of a crisis to get rates to come down? Again, I don't think that actually happened because I don't think that that much coordination can actually go on. And there's not like a dark smoky room out there. But I don't know. Can we have fun with conspiracies?
That's a good that's a good point.
I'm just saying there's motive.
I like it. I like it.
No evidence, but Anyway, so okay, let's talk a little bit more about inflation and are rates going to go up or going to go down? Again, I mean, people's livelihoods and investments are on the line. And again, fast forward to the Archimedes report that there are a lot of folks counting on rates to be lower by the end of this year. Probably not. But as a couple of days ago, maybe, Matt. But let's look at least the CPI and the PPI. CPI being Consumer Price Index and the PPI, the Producer Price Index, recently both came out. This is what the Fed. The Fed's also looking at PCE, but let's look at inflation.
I can
the
give
consumer and then the producer, Matt.
A quick rundown on the consumer side. Inflation came in at about the expected rate, no lower or higher. However, it is still elevated. It's 6% year over year, 5.6% for core inflation, which excludes food and energy. The month over month inflation is at 0.4%, still pretty elevated, but it is down from 0.5 growth the previous month. Core inflation was up 0.5%, which is a little higher than 0.4% last month. Still fairly elevated, especially if you look at the month-over-month numbers, but not going crazy. Still, it's not going away as fast as I would like it. I sure did like a couple months ago when the inflation numbers showed 0.1% month-over-month growth. We're headed down. Prices aren't declining very quickly. So what's bringing and keeping inflation up? It is shelter. I just said before, I refuse to entertain an inflation discussion without someone bringing up shelter and why they think maybe that shelter should or shouldn't be part of it, because I think it's a big part of it, and it's a little bit of a lot of it of a lagging indicator. Rent of primary residence is up 8.8% year over year, and it is up 0.8% month over month, a little bit more than the previous month's 0.7% monthly increase. This is I don't know when it's going to start falling, but the rate at which shelter falls is not going to be instantaneous. So it'll be a slight decrease in shelter inflation until we get back to normal. But it's not going to be very quick because of the way that they calculate shelter. They just don't move that quickly. So yes, even if it starts going down, we will still have shelter. I think unfairly keeping the nominal inflation rate up.
Yeah.
Oh yeah. Also, eggs are down. Just in time for Easter, eggs are down. Make your souffles, make your meringues, make your frozen custards. Great.
Thanks for that reporting, Matt.
Yeah, no problem.
No, it's true. I mean, shelter is still up, 8% essentially year unadjusted over the last 12 months. Other items that are also up, Matt, that are a little more volatile. That's why I take it out of core. Gasoline is up month over month, but down year over year, as well as transportation services that are up 1.1% over the month and 14.6% for the year. So there are some other pieces, but I believe transportation services, they're much smaller rating than shelter and energy, unless we're looking at core. So I guess I don't have the full breakdowns right here, but yeah, to your point, Matt, if shelter was looked at through a different lens, and it's debatable whether this is the right one or not, we would be looking at much more subdued growth, and it could appear that this could be the beginning of a downward trend of inflation, or that is at least more or less the narrative. And I think that allows us to transition to this PPI report that was released yesterday. PPI is a producer price index. This is what manufacturers, what is costing them, and the headline is that the producer price index for final demand decreased 0.1% in February, seasonally adjusted. The U.S. Bureau of Labor and Statistics reported final demand prices advanced 0.3% in January as they adjusted it, and declined 0.2% in December. So this PPI report, Matt, is a little bit more forward-looking than CPI. As you could imagine, the goods the goods and services have to be kind of produced before they can be consumed.
Yeah.
And so this is potential good news for those looking for lower interest rates sooner because of lower inflation print, giving the Federal Reserve some room to actually at least plateau, if not actually lower rates at some point. But they're going to need to panic like we're in right now, Matt, in addition to lower inflation to actually lower rates. If not, they're just going to keep them where they are. I don't see them do anything but plateauing until there's some real pain.
Yeah, it is interesting looking at that producer, the PPI charts, and you can track it from June. Now the Fed started their rate hikes around March, I think, and then it stayed pretty steady, and then from June to now, steadily decreasing the prices there. It seems like a much more accurate picture, and like you hear about these, and you hear about the tech layoffs, but there's other elements of demand that were going down. And I think that this is a really accurate reflection of it that maybe shouldn't be ignored, but I'm not sure, what Powell listens to, if there's a new was it PCE that's coming out, I'll have to keep my eyes open for that.
Yep, I'm sure. I know. Yeah, no, Matt. I still think that there is a window for the somewhat soft landing, or that we can get through this and things not be not too horrible at the end of the day. I mean, there's going to be some pain, but it might be reasonably well isolated and contained, because you do see things kind of gradually moving back to normal. But again, like a wrench getting caught up in some of the gears of the economy right now, just basically locking everything up could send us downward, and then all of a sudden we could be in an actual deflationary environment and have the opposite problem. But in that case, that would allow the Fed to lower rates once again, and maybe all of a sudden we're going to be back in some weird new normal. It's going to be like 2014 all over again.
Well, yeah. Well, so, and this is what I'm kind of thinking, and this is only just in the tech sector, but that area was maybe more sensitive to interest rate increases than other areas of the economy. And maybe if these high interest rates remain, they kind of persist, then it will spread. But laying off people is a cost. Yeah, because you're going to have to spend time to retrain. If you want to rehire those people back, you're going to have to waste some time, not waste, but still spend money and time retraining all those people, and to let them go. I actually heard before, and this article was quickly steamrolled by other news of layoffs, but I heard about some companies were actually retaining a little bit more talent because they didn't want to have to fire and then rehire again. But largely these companies, at least in the tech sector, are firing on a larger scale, and they're not thinking about rehiring.
They're trimming down. Exactly. I think Meta announced laying off another 10,000 employees this week, Matt. You're absolutely correct. Now, what I keep hearing anecdotally is that these folks that are being laid off in the tech industry, they're either able to find new jobs in the tech industry, or they are in general just very sought after, maybe outside of the tech industry, because all of a sudden everyone's like, oh yeah, you were a software engineer for Google. Well, every company has some sort of technology software needs these days. Like, we'd love to hire you.
Yeah, the tech worker, the tech roles in non-tech companies. I was more thinking about like these examples of these businesses that see, okay, I'm going to spend less. If we see these sensitive to interest rate increases,
they have
businesses,
to.
They're like, okay, let's get lean. Are other businesses elsewhere in the economy going to say, all right, I have to tighten my belt too? And I'm sure it's already happening.
It is. You're right, Matt. It's going to happen in every industry right now, because people are dealing with not only pressure from valuations like that the tech industry is feeling, and interest rates. They are no longer having just free money to support just a massive and bloated workforce, but there's expense inflation. Specifically bringing it back to multifamily and real estate. I mean, and I wrote a LinkedIn post that covered some of this recently, Matt, but you've got payroll that's up, insurance is up, property taxes are going to go up if they haven't already. Interest expense if you're on a floating rate mortgage is also gone up. Turn costs are up, repair and maintenance, paint, everything. Expenses are up across the board in a period, the last 2 quarters of negative rent growth nationally, unless you're in a market like Indianapolis or somewhere in the Midwest that we're going to talk about here in a minute. But even in those markets, it's been tough. Occupancy nationally across the board has decreased 100 to 400 basis points. So your NOI is lower, your cap rates, the valuations, the market sentiment in interest rates, there's relativity between or correlation between interest rates and cap rates to some degree, and we're seeing that. Cap rates are higher, valuations are lower. It's like super simple math. NOI divided by cap rate gives you your value. Your value is lower, and it's kind of exponential. And your numerator denominator, they're going the wrong direction. So if you want to get even close to bring your value back into range, you can't really change your cap rate. That's the market. The one thing you can only affect demand so much. I mean, you can add value to your property. All of your expenses are up to do that, though. So the one thing you can try to control is expenses.
Yeah.
And so there's a huge push in the property management world right now that we are somewhat new to. We've been doing it for less than a year, but we're like, we're in the deep end right now, digging through it, which is a great time because we also like are building our systems in a time where we have to be very lean, and we have to use a lot of technology, and we have to think about centralization from the get-go. But a lot of my time right now, Matt, is spent on thinking about how we can do things more efficiently,
I've walked by,
but also
meetings.
better. Yeah.
Yeah. That's
cheaper, more efficiently, but also how do we provide like a significantly better service all at the same time?
Yeah. And I think that there's a lot of opportunity. It is a little bit it's a little bit of cruel irony that a lot of prop tech companies were kind of caught up in these recent bank collapses, and they could maybe provide that service and help people to get leaner on their expenses and still deliver excellent service. But someone made a bad bet on interest rates, and that's not helping.
Yeah, well, and my interview with Paul Bergeron, he just wrote a piece on that exactly, where he was looking at some of the not only exposure from like Signature Bank to investing in commercial real estate, but all these prop tech companies had their accounts at Silicon Valley Bank, and it was a concern for a lot of those organizations. Well, Matt, I want to talk about something that had been a somewhat reoccurring theme in our conversations. And if you had to ask me, Spencer, what type of apartments are the best to invest in? What class? A, B, C, D, value add, core plus. What's the best? You can only pick one. If I had to choose one, to be solid B class apartments. There are times where I love A-class assets. All price and returns are relative, right? There are times where I think workforce housing, C+ makes a lot of sense, depending on the location, market cycle, all that stuff. But B, like, again, relative to a decent price, is just right smack dab in the middle of demographics moving around. And economics moving around. You're always got people coming up and down through the economy. You can't build them for the price that you're buying it for. And what Carl Whitaker from RealPage article is talking about today is the premium the Class A apartments command over Class B apartments. It's 28% premium, but that's actually way much smaller than it used to be, Matt.
I took issue with the word commanding, but that's about the only bad thing about this article. A lot of great information. And it also emphasizes like the fact that when you're building new apartments, you're not building the B class, you're building the new, nicer apartments. I think it's still prohibitively expensive to move an apartment building from one city to another city. But I have been thinking about this, and a lot of these reports that came in on the multifamily market touched on supply. Within a specific market, I can at least imagine somewhere on one side of the town thinking maybe they'll move 20 minutes away because rents are a little bit cheaper. There's a little bit of push-pull. So I think that a market-specific apartment supply, if you're building a lot of A units, then that gap between the A and B gets a little bit smaller. But especially within the specific submarkets, and he does have that submarket information in the RealPage article, in talking about some of the markets some of the submarkets that are getting the most supply. And yes, Sunbelt seems like it's leading. And for a lot of these markets, DFW, we have Charlotte, Phoenix, Nashville, Austin. They're all adding a good deal of apartments to their supply, and it does seem like they have the smallest gap between A and B class apartments.
Yeah, it was really interesting graph, and I haven't seen the specific topic looked into in this way. So props to the RealPage team and Carl Whitaker put this together. Carl was a guest on the Great Report not too long ago. Appreciate having him on. Hope he comes on again. Maybe we can get him to talk about this. But yeah, Matt. So the metrics that they're looking for, especially for the folks listening on the podcast, is percentage of inventory under construction.
Yeah,
number of units under construction, and then the percent gap between Class A and Class B rents. And then they also have, which this is really cool, because they talked about like how much concessions would a Class A property have to give to kind of be at par with Class B rent. And so the other metric for these submarkets are weeks free for Class A rent to equal Class B rent. And for just the top of the list, this could be a fascinating case study. But in McKinley, Texas, submarket of Dallas-Fort Worth, the percentage of multifamily apartments inventory under construction is 23.4%. Nearly a quarter of with current inventories being built right now. I believe 40%, I think I saw somewhere else in this report, Matt, has just been built over the last couple of years.
To put this into context, if you expand to a full market, and now you can get these crazy things because they're focusing on a single submarket, and these are all really, really active submarkets. To put it in context, a single market would be crazy if they got over 4%, and we're talking
starting
at the low end.
High, yeah, exactly.
And on the low end on this is like 14%.
Yeah, and exactly. They have 7,172 units under construction. In Indianapolis, we have around 5,000. This is a suburb of Dallas. Now, I will say what's not on here is the employment growth and the population growth of McKinney, Texas. It's nuts. I know developers, some investors investing in this area. It's all the corporate headquarters, there's jobs. There's a reason for all of this. But the difference this is why, again, if you could have bought a B-class apartment complex in McKinney, Texas, and it was below market rents, I'm sure what they were at one point, if there probably only a handful of market, older vintage apartments. I'm sure there are some, but not that many, because not that many people were living out there 10 years ago. But the gap between A and B class rents is 0 to 2%, basically no gap. And there's only 1 week. So A class apartment only has to give 1 week of concessions to basically be on par with the B class. There's a lot to unpack there, Matt.
Yeah, it illustrates how much I think maybe A class falls to meet B class, and how much B class really, for that gap.
Well, that's the question. Is it the A class has fallen recently, or is it the B class in McKinney has been able to rise so much? Because a lot of this is, think about the value add business strategy.
Yeah.
The general thesis. My rents are $1,000. The Class A stuff's $1,500. I'm going to move rents $300 to bring leave a $200 gap between us and the Class A. But what if all of a sudden you see a lot of growth in a market like McKinney, just keep pushing rents because there's so much demand, closer and closer and closer to Class A. At the same time, all this Class A is being delivered, and they can't get any rent growth in Class A, although they probably have.
I'm sure it's meeting in the middle, but the first thing I thought of,
point.
I thought maybe it was A, and then at a certain point, you need an apartment, and it's probably like a blurry line. Obviously, it would be talking about such a small margin, but I do think that at a certain point, it's like, well, I know that this Class B apartment's expensive, but we need somewhere to live. And that might be a decision a tough decision that renters are having to make there between those two.
I guess my argument for why it's maybe more the B's have risen more than A's have lowered is because we have seen a lot of rent growth in the Class A segment the past couple of years, Matt. 2020, 2021, 2022, ton of growth in Class A. I know because we talk about it every week. But look at this chart here. It shows the difference really declining between 2019 2022. And what else is what else has been going on? It's everyone and their mother's syndicator doing value add deals and improving the properties and making the units closer to luxury in Class A. But we all know a 1960s vintage with granite countertops and LVT flooring, while it does look much better than the original, it is not your 2023 Class A community with the, Rockstar Fitness Center and pool and whatever else. It's never going to be that. It's sort of close, but now all of a sudden is the gap too narrow. Carl, again, the headline, I wouldn't say it's completely misleading, but I think maybe right, Matt, to take issue with commanding, because it's really that gap. The headline to me is the gap has narrowed over the past several years.
I also wonder what the definition of Class A and Class B is, and what if there are key features, or if it's just year of vintage that they're kind of going by, or I'd really love to know, because I'm sure it's a very blurry line that fades in and fades out.
And it's always depending on who you ask. Some people give it a vintage year. Some people say it's the location. Some people say it's the income. Some people say it's the rent. Some people say it's a variety of those factors. And there's certainly not in Webster's dictionary, that's for sure. Although a lot of people have descriptions here or there. Matt, look, this is getting right into this report. Apartments.com publishes February 2023 rent growth report, released on CoStar. This is beginning. We've seen this theme repeat now, Matt, for the last couple of weeks. We've got 3 reports back to back that all are underlining Midwest strength.
Yeah. And you can't argue it. What did I?
We've been saying it, but But I mean, let me put it this way: since I've been raising capital and doing multifamily deals, really kind of the last, call it 7 years or so, I've many times have I talked about the resilience of the Midwest and Indianapolis, and how Indianapolis' economy is relatively recession resilient. I never like to say we're recession proof, because nothing's recession proof, but very resilient. It's an overused phrase. People talk about it all the time. But now, I remember 2008, again, not recession proof, but fared fairly well compared to all other markets. Now we've had the COVID, the pandemic, and now we've had whatever we're in right now. And Indianapolis is number one. Year-over-year rent growth across multiple sources in the Midwest in general. Is on in the top 5.
Take a look at the top markets for rent growth in this CoStar report, and then there's another Yardi Matrix report out this week, and be disabused of the notion that the Gray report overvalues the Midwest.
We're just reporting the facts here.
This is straight facts. Indianapolis, Chicago, Cincinnati, Columbus, Cleveland, Kansas City. They're all highly ranked in either the CoStar, Yardi Matrix, or both. A lot of them really is both. And it's what is interesting. And we have been praising the Midwest, but we're not really. Even when times are bad, we don't suffer the huge swings like many Sunbelt markets are suffering right now.
It's not like Indianapolis is usually at the bottom of the list. Usually we're kind of just above the national average, from all, KPIs and growth metrics. And then we kind of fluctuate, up into the middle of the pack, maybe down. And then all of a sudden, in times of crisis, it seems like we always float to the top. So the average is really, the average is really good. This graph is super blurry. I don't know why CoStar put this image on here.
I agree. I had to find another source for that specific graph that I used for the newsletter. But for the overall national numbers, their year-over-year rent growth is at 2.9%, and they also have a small but significant 0.15% month-over-month rent increase that follows another last month's 0.4% monthly rent growth. So they are actually arguing that maybe this is a sign of positive momentum as we approach peak renting season. And I think that it is a good sign, because the CoStar numbers, now that 2.9% is relatively low. We track a lot of different rent reports, and CoStar is among the lower rent growth in terms of what they report as their national average. And also, along with that kind of low nominal number, is the trends for CoStar a lot more sluggish, a lot smoother, less squiggly and volatile than in the other than some of the other reports. So the fact that they have 2 consecutive months of rent growth really could be a strong sign of future rent growth in the months to come as we approach peak renting season.
I mean, Matt, not to beat a dead horse, but I mean, do you see in Indianapolis pull away month over month by market in February?
Yeah.
1.2% growth versus the next top is Boston at 0.9%. That is again just it's surprising.
The margin the margin between us and Boston is almost the is almost double the actual rent growth average for the nation.
Yeah, fascinating. And the Sun Belt highlights weak rental market. And this is to say that things have not been easy in Indy.
Mhm.
And like so now I'm there. It's been a challenge, and we've seen demand decrease without a doubt. We've seen occupancy drop without a doubt. Expenses have risen, but I can only imagine what it's like in other parts of the country, Matt.
Yeah. And both in this report and in the report from Yardi Matrix, the idea is that we are having that there's a little bit more of a moderate demand. Demand has moderated. It's not, down, but it now can't punch through any new supply that comes online. So in those situations, some of these markets that are seeing a lot of new supply, plus the demand wasn't already, gangbusters. Those are the ones that are seeing maybe rent dips. I still think that Miami is it is one of the Sunbelt success stories that has not had this whiplash effect that that some of the other places have had. It's getting a lot of supply and it's doing great in terms of rent growth. There's like nothing you could do.
I agree. Miami's not only a fun place to go and visit. People like to live there. It's also very tax friendly, and I think there's some supply constraints. They're not as building nearly some of those other big boom Sunbelt metros, Matt, as we've noted. And they've really kind of really been able to kind of stay ahead of it and continue to perform. And not every market in Florida has continued to outperform. Matt, but I got to stay on the Midwest.
Totally.
Switching over to the Yardi Matrix report since you brought it up. This is a quote from the Yardi Matrix report for February. Multifamily report. It says, meanwhile, low volatility Midwest metros in Indianapolis with 9% growth, Kansas City 7.9% growth, have cycled to the top in part because they remain inexpensive and have not increased inventory as much as their high growth Sun Belt peers. New York and Chicago are also displaying resiliency as attractive cultural centers where people want to live, if not work. So it's, again, as an investor in the Midwest, this is all great to see, with the Midwest claiming 3 of the top 5 spots in the Matrix top 30 metro list for year-over-year rent growth. Again, I mentioned Indianapolis, Kansas City, Chicago, also on that list. And so even from just on a month-over-month basis as well, we're seeing a lot of Midwestern markets do quite well.
Yeah. It's also interesting kind of looking at the lower end of the rent growth lists, both for CoStar and for Yardi Matrix. Now, Yardi Matrix has let's see, I'm just going to look at for month over month. They have Las Vegas, Seattle, San Jose, Phoenix, Orange County on the lower end for their month over month, and then for their year over year, it's Las Vegas, Phoenix, Austin, Atlanta. A lot of those are the ones that are getting new supply. Some of them, it's not like perfectly correlated with the amount of supply that they're building. And so that makes me think that a good portion of this rent slowdown is this kind of counter reaction from the runaway rent increases a couple years ago in many of those markets. And Yardi has an excellent an excellent chart at the end of their report where they measure the amount of construction that is forecast, or I'm sorry, their completions as percentage of total stock, and also their year-over-year rent growth. And you can draw a rough correlation, but it's not perfectly correlated when it comes to new supply and the rent growth.
Is this the chart you're looking at, Matt, looking at employment and supply trends with forecast rent growth?
Yes, exactly. Yeah.
Yeah, exactly. So just you said, I like looking at, what the job growth is. And then, so that's an indication of potential future demand, creating jobs. People want to move into where those jobs are, typically leading population growth. And then what's supply look like? How much we're completing as a percentage of total stock? And then, all right, taking that together, maybe let's look at maybe where rents are going to go, and then where are we year over year in terms of rent. Again, Indianapolis with 9% rent growth year over year. They're forecasting 3%. Job growth is forecasting, it's the 6-month moving average as of December 22, 2.5%. Then completions as a percent of total stock as of February 23rd, 0.7%. So good demand, Matt, low supply. It's a good recipe for success, in my opinion. But, the downside to those numbers, again, just picking on Indianapolis now, is the job growth, while positive. And, let's see, I'm not sure if they have the average or not. I don't have the average here, but probably just at the average, maybe even below average, compared to New York, which is, 5% job growth, or a Dallas, which I believe is topping the list at 6.5% job growth. But that is also relative to, supply completions percent of total stock. But Dallas is delivering, 2% versus Indianapolis 0.7, or a market such as Denver with only 3.5 year-over-year job growth, building at 3.8% completions as a percent of total stock, compared to get to Indy's 2.5 and the 0.7.
Yeah. The big pullout, and I'll pick on Austin now. Now that we're done with Indianapolis, is they're building 4.9, the leader of the new supply coming online, and they're the third lowest when it comes to rent growth, even though they have 5% of job growth, which is among the leaders in this list. Their rent growth is suffering, I think, because all of that new supply coming online. Indianapolis is actually the third lowest. At least as far as I have sorted this list in my head here, they're lowest when it comes to the amount of completions as a percentage of total stock. 2.5 is nothing to, it's not the worst year.
Steady Eddie, Matt. Steady Eddie. Steady, slow and steady wins the race. All that stuff. Okay, one other thing. Again, I love these Yardi reports because they have just some different metrics that others don't have that I like to keep track on. One, always, Matt, is the rent to income ratios as of January 2023. We focus on this decent amount, but come back to the top. All just look at all units. They also break it down lifestyle. Again, you were talking about definition of Class A, Class B. Here it's lifestyle units, renters by necessity. Maybe a better way to look at it. CoStar's got a star rating. Anyway, Sacramento, 42.9% rent income ratio, Matt. 42% of your income on average, and average is, is average best, should be median. Anyway, 40% of your income going to your rent should be closer to 30. Anything over 30 is rent burden, so they say. The next is LA, 33%. Now back to Sacramento, though, the renters by necessity, that's the people who don't have an option, have to rent, can't buy a home. That's a lot of California. That's a lot of people in general right now. 59%, 60% of their income, just about, is going to rent.
Wow.
How's rent control working out for you, Sacramento?
Yeah, it's like double. It is almost double more than double. The lifestyle units, 29.1, renter by necessity, 59.5. That's such a stark difference.
Matt, you can only have 10 rounds in your magazine. You can't have all the features, and you're going to pay 6% of your income.
Yeah.
You get beaches, you get mountains, you get good weather.
That's it's pretty stark. And Sacramento's not really leading. It's not really leading in terms of rent growth. I haven't really. It wasn't.
It's been pretty well, I think, the pandemic, because everyone's in the Bay Area, but yeah. But I mean, you can imagine a lot of places are kind of around that 30% mark. Just a handful are above: Inland Empire, Baltimore, Orlando, Orange County, Washington, D.C., Los Angeles. Matt, these are a lot of markets that have some degree of rent control, if you believe it or not. I don't think Orlando does, Tampa does, although Orlando actually may. I know they were discussing.
Oh, yeah, that was part of the discussion,
Maybe, I don't think maybe it's just a discussion. Let's go to the bottom now. There's a lot of places in the middle. Affordability, which this Yardi report cites affordability. Indianapolis affordability is a major driver for a reason why it is attracting so many people and so many renters. Kansas City, only 24.6% on average of your rent to income ratio. Indianapolis, 25.2%. Austin, surprisingly, Matt, is not that bad, 25.9%. That's actually pretty
Miami,
good.
not so. Yeah,
Miami's pretty
not
good.
so bad either.
Do you think
it's
that's the issue with average? Do you think because like you've got like is there a high concentration of like billionaires? Like the Elon Musk moved to Austin and like you take the average and so they're like, oh, everyone's good.
Yeah, I wonder if there's
in Miami, same thing.
kind of thing. Yeah, it is interesting. I think that the fact that Miami, now this is in another report, but the fact that Miami has not permitted as many housing units per capita as some of these other markets, that may play into it. But Austin's another thing entirely. You know, you'd think that it wasn't an affordable housing market if you were just looking at the amount of rent growth that they're having. I mean, it's a very actively growing city, and yeah, it's interesting to get that reminder that
the renters by necessity column does tell a little bit different story. I mean, Austin's at 28%, which is a little bit higher, still under 30. But Miami, though, it's the big difference between the renters by necessity and by choice, where it's 36% for renters by necessity. So it's a really tale of two cities versus the renters by choice, 23%. So 23.9%, incredibly low. So I think there's a lot of money in Miami, and then again, I don't know if that's everything, but that certainly could be part of it.
Yeah, only LA and Sacramento that we've already discussed. Only LA and Sacramento have a higher percentage of income for renters by necessity that they're paying on their apartment rents. That's interesting.
Yeah. All right, Matt. Just to continue our theme of Midwest appreciation. And this is not to come across as like a victory lap, but we're just reporting the news as it comes across.
Objectively,
this is as objective as it gets. But like no one I go to these conferences, Matt. No one talks about the Midwest. Like no one go to these national apartment conferences. You go to the NMHC strategies conference. Like it's 30 minutes on the Sun Belt. 10 minutes on a coast, 10 minutes on another coast, 10 minutes on the Mountain West, and then like then they're like, in the Midwest exists. Now on to, and like they mentioned, they talk about Chicago, and they're like, and these other markets exist, but we're gonna move on to talk about the Sun Belt just a second time. And part of me is like, hey, you forgot something. We exist, but the other part of me is like, sitting around going back like this, looking. Like, hey, if no one knows about it, that's fine.
And
more deals for us.
Exactly, the numbers don't lie, and and that's another thing that has populated our conversation is the investment interest. It may be slightly less liquidity in like it versus a gateway market, but it's not as competitive, and you can get a little bit higher cap rate sometimes for equivalent cash flow. But maybe if the secret's out.
A lot of the people complaining about liquidity in the Midwest were probably customers of SVB and Signature Bank. Okay. Globe Street, Midwest apartment rent growth outpaces other regions. This article is featuring a handful of markets, especially Oklahoma City. Oklahoma City has seen the nation's fastest metro level rent growth over the past 12 months. That's a different story than we read about Indianapolis, but still good news for the Midwest. Matt, what say you?
Yeah,
I say this article right before we did this too, so I'm sorry that I'm asking you about it.
No, what I'm googling is I didn't know that Apartment List they must have released their monthly rent report this. This is last month's. They're talking about last month's rent report. So we've already covered that. I was just covering my bases.
They're we're ahead of they're covering their report from last month.
We have their data.
Okay.
It is more of the same, and it's interesting to see this attention. And
Matt, are you worried that we're moving the narrative?
Well, and that's the thing too.
Does the Gray Report have an outsized? I'm asking this meta questions here. Do we have an outsized influence on the multifamily media?
Yeah. Well, yes, and yes.
It's a lot of power, is a lot of responsibility.
But it's
I'm asking this: have we been pushing the Midwestern narrative, and have we because I'm not just saying this, but we have been maybe talking about this to some of these our authors and journalists.
That's true. Well, but
the data they're not making up the data though.
Yeah. I think they were dragged. I think they were dragged kicking and screaming to making these headlines about the Midwest.
They're dragging, we've dragged them kicking and screaming, and I think we've highlighted it.
Yeah.
Of like, look, have you seen this? Like, by the way, did you remember that this happened these past few cases? And they're like, interesting. Let me go back and look at that data. I've never cared to look. I don't know. Yeah. I'm just is our big ego here at the airport.
What I like is that they seem to be lumping Oklahoma City in the Midwest, although I'm not sure if that's exactly what they mean. They say Midwestern markets
don't even know what it is, Matt. People don't even know.
Well, it is funny, you know, it seems like every organization has a different view of what states make up the Midwest, and then
there's a map or two somewhere.
Yeah. But sometimes they'll loop Oklahoma City. Maybe it's not south enough to be the Southwest. It's not west enough to be the West. But even without it, Indianapolis, Chicago, Columbus, Cincinnati, Kansas City, Milwaukee. Those are a lot of successful markets, all in the Midwest. And again, what I want to maybe repeat is I don't think that this success is going to take away future success in the same way that the Sun Belt's growth a year and a half ago kind of seemingly took away the growth right now. I don't think we're borrowing against the future as much as we are kind of maintaining a steady growth that Sun Belt and other hot markets like Boise are reacting to a little bit right now.
Yeah, no, I think you're right, Matt. I don't necessarily think that like Indy is now picking up steam as much as it is that just, again, it's just the steady Eddie, just linear growth, and we just keep trucking along, slow moving turtle.
And this is like, I have a handful of stereotypes of these rent growth trends that after, you know, we go over these monthly rent reports every month, you know, multiple times a month. And you see different stories like Chicago. And I've talked about this before, but Chicago didn't do well, and now it's catching back up. Same thing with New York. It is one of the ones that are kind of building up a pool of rent growth that they didn't have before, and where other ones, Sunbelt, went down. Miami, that I mentioned before, always strong, nothing can touch it. But Midwest, consistently elevated and steady. And then, and what I want to avoid and what I'm scared of, but I don't think it's going to happen, is this reaction where Sunbelt was a place like Phoenix was huge a year and a half ago, and then rent growth is now maybe negative month over month for Phoenix.
So, it is, yeah.
What you want, and from an investment standpoint, I'd rather have something where I could predict. I'd rather have something shocking as is, something a little bit less volatile than something that's expected, that I kind of know what I'm getting, that is not maybe as sensitive to a splash of new supply. I think these Midwest markets are because they're less trendy, it's easier to make kind of a bet on them or an investment on them than it is where you may not know whether you're on the upswing or the downswing.
Yeah. You know, Matt, we don't have control over, you know, who our parents are, you know, or where we were born. And you and I are both from Indianapolis, and, you know, we're both involved in Midwestern real estate, Indianapolis multifamily, but multifamily across the Midwest. You know, if we were born in Georgia or in Arizona or any other state, you know, as long as it was a somewhat conducive market. So unless we're, you know, in markets like New York or California, you know, if I had found a great capital, and, you know, we would most likely be working in those markets because those are the markets that, you know, we know. The reason why we started investing in Indianapolis wasn't because I did an analysis of every market in the United States or the top 10 and decided on Indianapolis. That's what most people do, and it's the right thing to do. But I don't know those markets, and I know Indianapolis, and I did enough research to know that it was a good enough market to start investing. And I was just figuring it out at the time. And so it now, as I have, you know, built a career in the real estate industry and multifamily investing, I've come to really understand, you know, why the Indianapolis economy and a lot of the economies in the Midwest are so resilient, and the unique characteristics. And they're not necessarily the best markets, but they have some unique characteristics that are attractive for a conservative, cash flowing investment that I think has outsized return potential because of the mispriced risk in the market in the capital flowing to the Sun Belt as opposed to some of these Midwestern markets.
Yeah.
So
And it could be backfilling my own ideals based on, the features of the market that I was born in and the market that we're already investing in. But
yeah, that's all good.
I also think if I'm looking for new markets, I want to look for one that's a little bit like Indianapolis, kind of an under the radar, consistent, steady performer. Maybe it is on the southeast coast, or maybe it's smack dab in the middle of South Dakota. But if you can find those features of the market that you like, then that's nice. But I also think, and what you have, maybe you didn't do the analysis, but you had that intimate local knowledge of like the submarkets and this experience within that single market that you can really draw on, that perhaps could be a lot more impactful than just knowing what's broadly happening in the market in general.
Yeah, exactly. All right, Matt, let's move to this apartment list piece, and because then I have to, unfortunately, I have to run.
I'm glad that you brought this up. Now, I don't think that we were talking about this. Is actually connects a little bit more to the RealPage, to some of the RealPage charts, but again, kind of looking at a submarket. And some of the submarkets in that RealPage article, they were in the 10,000s, or I'm sorry, upwards of 7,000 just in one submarket. So having that knowledge of what neighborhoods are growing in your chosen market is really important. But
yeah, no, it is. Real estate is always local, and it's not just the state, city. It's the neighborhood, and having that intimate knowledge can give you an edge. And again, there's no such thing as insider trading in terms of, private real estate. It's having that unique knowledge no one else has that can give you a huge advantage.
Yeah.
Look at housing permits, man. Annual housing is permanent in the United States.
So this is a great article, a great breakdown of apartment construction with some information on single family home construction as well. And they rank each market. They have a chart here that's ranking them for home permits per capita. We've seen completions as percentage of current apartment supply, but this home permits per capita figure kind of widens the scope a little bit. I think really gives a really nice snapshot of the housing activity in a given market, as well as the balance between, okay, are they permitting a lot of apartments? Is this market really keen on building single family homes? And all of them are different. Just looking at this, a place like Nashville is permitting 1.7 multifamily units for versus 7.5 single family homes per capita. Now, a place like Austin and they lead by far, is permitting 9.6 multifamily units, roughly even a little bit more than the 8.6 single family homes. You scroll down all the way nearer to the bottom, is Miami Fort Lauderdale, which is permitting 2.2 apartment units and 1.1 single family homes per capita. Clearly near the bottom of the list, definitely not 9.6 or 8.6. There's the variety in the character of each of these cities. You could really see it in a small figure. It was really, it was really,
and it's just amazing the big spread. And I'm really surprised, again, as you mentioned, but with Miami, markets like Chicago, and even LA that are really relatively down closer to the bottom, although some of those markets like LA are pretty big. So I guess that makes a little bit more sense. But Matt, and I guess, a lot of times we're looking at, what is currently in the pipeline, what are our units under construction. But this is, more permanent. So this is really kind of looking even further out into the future.
Like that number is going to be smaller. It's not like they're going to build all that, but it is an interesting, I think, gauge of maybe the appetite and what is allowed. So maybe there's more government and regulatory hurdles in a place like Miami. Maybe there's just not land available. I know that there's some factor there that is kind of squelching supply. I also think the chart that they have a little map that you can see how the character of things has changed. Yeah. So another thing they have in this, and just to kind of close this off, is and I would encourage everyone to read the full article. But this this animation that they have that shows the amount of housing permits per capita from 1990 to 2022. And you clearly see an increase in housing activity, but you also see the regional increase in places like the Southwest and the Sun Belt and all those popular places. And even actually in, you can see a flare up of housing activity in Michigan and Wisconsin too. So.
And you see the drought after the financial crisis. I think for me is the most illustrative. Matt, incredible report. Just a reminder to everybody that you can get not only every single video of the Great Report by subscribing to the Great Capital YouTube channel on YouTube, but also sign up for the Great Capital newsletter, the Great Report, at greatcapitalllc.com/newsletter. Hope everyone has a great rest of the week and catch you on the next episode of the Great Report.